Hi, everyone. I'm Rick Benson York. Today is Tuesday, January 10th, and welcome to this week's In the Know Trader Show. We've got a good lineup this week for you. In our trader education portion, let's have a quick discussion about what's your game plan for 2023 and what mistakes did you make last year that you can learn to correct for this year so that they don't happen again. And then we'll go over the top 10 Dow Jones Industrial names by market cap, starting off with Apple. And you can see Microsoft, Visa, J&J, UNH, JP Morgan, Walmart, Procter & Gamble, Chevron, and Home Depot. That'll round out the show. Before we get into things, just want to remind you of the products that I have. We have a weekly ETF Tactical Trader Report, generally comes out on Thursday nights. This report gives you a deep dive into all the important markets that help affect the U.S. equity markets. So we're talking about the U.S. fixed income market, credit spreads, the commodities markets, the dollar. We do a deep dive in the S&P itself. And then I give you a new ETF trading idea each week, as well as go over all open trade recommendations we have each week with updated charts and potentially moving, if necessary, targets and or stop outs as needed. And that's what we get in the report. And we also have a monthly 7-Eleven report. This is something I'm extremely proud of. We just finished up 2022. And you can see just below here in that report, and the goal of this report is to outperform the S&P 500. And we do so by giving you broad exposure to the stock market by being invested in no more than 7 of the 11 SPDR macro sector ETFs each month, like XLK, XLE, XLY, etc. There are 11 of those SPDR macro ETFs. We get you in no more than 7 with the goal of staying away from the underperformers. In 2022, this strategy outperformed the S&P by 601 basis points, and we outperformed in 11 of 12 months. It was only July that we underperformed. And since we started this report back in August of 2020, that's 29 months ago, we have outperformed the S&P by 11.79%. These numbers, I will tell you, are outstanding numbers. Very few people have beaten the market both in up move and the down move that we saw in 2022. We outperformed in both directions. And this report comes out once a month on the last day of the month to give you potentially new allocations for the next month. Again, we're only in 7 of the 11 SPDR macro ETFs. We have done a bang-up job, if I say so myself, of doing exactly what I set out to do, which was to outperform the S&P. You can subscribe to my YouTube video channel. Please go to youtube.com/intheknowtrader and click on the subscribe button. And on occasion, I tweet. So my Twitter handle is also In The Know Trader. All right, let's get back to this topic for this week, which is what's your game plan for 2023? So first off, let me say that you should have one, and that it is better to come into a year with a sense of how you're approaching the year, what you think will happen, and what strategy you're likely to play. Now, it's always possible that things change and that strategy needs to be altered. But it's a good idea to not simply shoot from your hip all the time, but to actually have a game plan. Are you more bullish? Do you think last year's decline was kind of the most the market's going to get, in which case you're bullish for this year and think that we don't likely take out those lows from October and that the market holds itself up? Do you think that we're going to see a significant decline this year, taking out last year's lows and going well lower the way people, certainly many people on the street are looking for? And I do suspect we will take out last year's lows. So because of that, I have a game plan that's the basis to how I'm thinking about approaching the market, including even this rally that we've seen to start the year and putting that into a context of what I think will likely happen going forward. Now, I lay that stuff out in my In the Know Trader report, in the weekly tactical report. You get a very good insight from me of what I'm thinking and how we're going to play going forward. Whether you subscribe to that or not, you individually should have a sense of a game plan. And a game plan is often more useful when you write it down and you journal it, you put it in print. It makes it more official than simply having it in your mind. So I think that most of you who at least are independent, individual investors, not professionals, it's a good idea to think about and then write down what's your game plan, including some potential modifications or left turns or right turns you might have to take. Those are already potentially in your head to start things off. But I will tell you, from somebody who's playing this game for over 40 years, having a game plan to come into and to help strategize and lay the context of what you're looking to do will be helpful. Because in real time, it's much harder pulling the trigger to, let's say, be a seller when, let's just say, the rally that has started from 2023, let's say it continues to go. And let's say you're in the camp that you want to be selling into rallies this year. You should kind of have an idea of where that is, not just thinking that you're going to be necessarily on top of things and able to pull the trigger to do that selling when the market is potentially screaming higher and everything looks great and every person you hear on business television is telling you the market's going higher, and what you read in the newspaper says, oh, you know, we're bullish this, we're bullish that, da, 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 da. It's much harder to then go and sell where you wanted to when everybody's telling you they're bullish. Disregard what the bulk of people say. You know, and I know that probably 80+% of the people that you see on any of the business televisions networks do not have, let's say, good track records. And therefore, listening to them is not helping you any more than the work you can do yourself. So if you're going to follow people, at least follow people that you believe have the game plan right and have proven in the past that they get things right. So I'm a big proponent of having a game plan to start the year, to laying things out, understanding that macro events happen that can easily change why you have to do that. But it's very helpful, and it's a disciplining effect to have a game plan. The same way a football coach is going to have a game plan going into that Sunday's NFL football game, the same way any sports manager, coach, etc., has a game plan. The same way you walk into a negotiation with your boss or something, you don't shoot from your hip. If this is a meeting set up, then you go in with a game plan of what you want to accomplish, what you want to say, with understanding that they may say something that makes you change how you talk or change what you're asking for, etc. But you want to have a game plan. It's no different as an investor. You should have a game plan. Which leads me to the second question here that I want you to think about, and an important one, which is, what mistakes did you make last year that you can learn from and try not to make again this year? So were you the type who said, yeah, I'm bearish, but then didn't end up selling anything? Was too afraid that when you were going to sell, it was going to be the low and the market was going to come right back up in your face, and you'd sell the bottom? If that's the case, then learn from that and stop being afraid of doing things and do and attempt to do and make the best decisions you can at the right times and places. Some will work, some will not. I know for me, some of the mistakes I made last year with my own account. There was a particular name that I bought beautifully and took out, let's say, let me think. I probably made about 20% on the name, but it was worth way more than that if I had stayed with it, and I ended up selling it because I was afraid to give back the profit. I'd done some bottom fishing and I was afraid to give back the profit, and I ended up selling out almost near like one of those interim lows, and then just to see the thing turn around and go higher. So I like to learn from that. I think about what made me make the decision when I made the decision, and try to learn such that I avoid that in the future. Think about the mistakes you made last year. Were you bullish bonds in a market that was pretty straight down? One of the worst years ever, if not the worst year ever for bonds. We can go across, it doesn't matter which market or which security, but there isn't any of you listening to this, or in fact, anybody out there who's in the market that didn't make some type of mistakes over the course of the year. Look at them and learn from them and try to improve. It's all part of being a better investor. And the most successful ones out there will tell you that they made tons of mistakes. In fact, if you're not making mistakes, you're not playing the game, or you're playing it so tentatively that you're really not involved and you're missing tons of opportunities because you're afraid of making mistakes. Mistakes are part of life. In every facet of life, there is not a single place that you don't try to do things that there aren't mistakes. It's all part of the learning process that starts off when you're a kid, and your parents tell you don't put your hand on the stove, but sooner or later you're going to put it on to see if they were right, and then you're going to burn yourself, and you're going to, okay, that's why they told me. I get it. They're not being overprotective. They're trying to just teach me the right thing. It's all part of life. So if you think back to 2022 and you go, gee, I really didn't make any mistakes in the market in 2022. Well, that's terrific, but it's also, you're probably looking blindly at all the things you did. And if you sat in the market the whole year and didn't do a single transaction, you didn't buy, you didn't sell, you didn't do anything, then you're just a long-term investor that's not generally in the audience that I address. And I don't do this for people to day trade and be in and out of things in 3 days. We are short to medium term investors. Something like the 7-Eleven report is a long-term investing type goal, but it takes it takes transactions to make us create the results we have. Nonetheless, let's just think about, in general terms, looking at what you did last year, what didn't work, and trying to correct those mistakes, and also acknowledging what did work and where you stuck your neck out to make a call on and sell something that might have screamed up, but guess what? It stopped at that downtrend line. It could have gone through, but it didn't. And then it pulled back again. And if you sold it when you said you were going to, well, then congratulations, because you probably put on a good trade. So that's what I want to say in this week's trader education portion. Let's now move to our stock focus, the top 10 Dow Jones Industrial names based on market cap. So let's move to our charts. We're going to start off with Apple. And Apple has broken beneath its cloud, which it did earlier last year in May, June, only to come back up through it, and then it broke again. What's interesting is a week ago gets its first standard sequential 13 of the entire decline. And if I draw a reference trend line versus the June low, you'll see we're still right in that neighborhood. So we made new lows that made headlines, right? But we're still hanging out there right now. So a potential place Apple could bounce from, especially with the 13. What I'm going to pay attention to is that this 13 count also came within the midst of a setup 6 count. So either the 6 count has to get killed, or we're going to finish out a 9 count from a lower level. And if you're a big fan of the market, you can do some nibbling down here on Apple, looking for a bounce. If it bounces, look for it to get to 138, 140 or so on the initial bounce. If you're looking for the market to potentially trade lower this year, then you probably want to be patient here with Apple, mostly because the first move up, when price broke the cloud, the first move up, also notice came on a setup 9 count, but only the price had broken through. The lagging line at that point actually bottomed against the top of its cloud the same time we made that 9 down. That's actually a potential buying zone. This sell-off that we've had since the August high brought price underneath the cloud, but also more recently in the last month or so, brought the lagging line beneath its cloud, right? This blue line has now broken through the shaded cloud. That's a more negative view on things. And therefore, if you want to be more patient, you wait a little bit more and you see whether or not this heads down towards, let's say, the 116 level or so, which would be more than 10% lower from where it's currently trading. So that's my view on Apple. Let's take a look at Microsoft. Microsoft has a worse picture in the sense that the first rally, or we'll call it the May-June rally, only came up to the cloud, didn't pass through the way Apple did, and then sold off, put in a 13 in September, kind of kept it sideways for a while, and now we've put in another 13. The lagging line is well through, has been through since this decline in mid-September. This big down bar here is the one that brought the lagging line down through its cloud. So this has a more bearish picture than does Apple, even though they both put in 13s last week. Initial upside target would be somewhere near 270-ish, somewhere right around here or so, which for almost the entire first quarter is the bottom of the cloud and potential resistance. Plus, it happens to now be the bullish propulsion momentum level on the upside. On the downside, this 13's risk level is all the way down at 191, and there's other potential support at 196-ish. So that becomes your downside. And the question is, do you buy this potential even triple bottom, 1, 2, 3 times we've been down here, associated with 13s, usually something I would nibble on the long side? Or if you're more bearish, do you wait? If you buy it here, you have to ask yourself, where do you stop yourself out? And that's probably the biggest question. You can make the case why you could be a buyer. How do you control the risk on this is the more important issue. And you can control the risk possibly through options. You can use a pure stop out level. You have to decide how much you're willing to risk. And if you got long at the current $228 or so, are you willing to risk down to under 191 on a percentage basis? Again, that's a fairly decent chunk before you would stop yourself out. So kind of in no man's land here as far as risk versus reward, kind of 50, let's call it 50-50 almost in either direction between where you'd rally to get to resistance versus where you'd sell off to before it potentially finds a bottom. So it's a tougher call. But for, in tactical, for people who shorter term, you can make the case that you can perhaps buy this. You're not getting real support here from MACD. And if I draw a trend line from all-time highs, we're still, let's draw it kind of something like that. You're still beneath it. And you've got yourself a little descending triangle here. So Not an easy thing to do, but I can make the case for being a minor buyer. And I can also make the case for simply waiting if you're in more of the, is this bearish camp or not? Normally, I have more of a definitive answer. Right now, I can tell you I could see playing this on the long side and also possibly just waiting further. Here's Visa, different looking chart. And in fact, close to now making a significant breakout in the sense that, notice for the first time on the whole decline, we're breaking out above the top of the cloud, and the lagging line is now playing with its cloud. That cloud level is 221.39. We are trading 221.60, so we're 20 cents or so above there. Let's see how the week ends out. If we close above there, and the CPI number doesn't halt the advance, then I'd say this is likely going up to 234 or so as the initial target off of this 9 bottom. So this one is potentially a buy with a little more strength. Now, another thing to think about, if you buy it, where do you stop yourself out? At what point would you be wrong? Even though this looks like what it would be a breakout, where would you be wrong? And you always have to think about that, is when you're a buyer, in an uptrend that's already, making itself established, instead of buying the bottom here, you're buying well until the uptrend. Do you stop yourself out if the trend line breaks? Do you stop yourself out under the bearish propulsion level, which essentially means if we properly close under this level of let's call it 203, then it's likely heading lower. The point here is that when you're buying something months after it made its bottom and well higher in price, how do you control the risk? And you have to be good at figuring out at what point does this sell off and change the game versus noise in the market that could potentially knock some people out. There are going to be people who stop themselves out underneath this trend line. The question is that the right thing or not? And to me, it all depends on how it breaks the trend line, when it breaks the trend line, what did it do before it breaks the trend line. No simple, for me, it's a formula, but it's why I tend to favor buying weakness than buying strength, because buying strength often is harder to figure out where the risk level is. Okay, let's take a look at J&J. Also, look, sideways market now since July of 2021. So for a year and a half sideways, the cloud isn't going to be very helpful here simply because the market's been sideways. So I'm actually even going to take it off. And let's just see, is there a channel? Is there anything? So we've got, I don't know, I kind of see that. And that, and we broke through that. If we hold on to this level here into Friday's close, if we're above 174.15, right now we're trading 174.89. If Friday holds above here and Monday the market starts moving up, then I'd say there's a decent chance this can move higher and reach 169, 170, or no, what is that? I'm sorry, 187-ish to 191-ish. If it breaks beneath here, then we're probably heading down towards 167 or even the bottom of the range. So a lot's going to depend upon how we close on Friday and whether or not we're above this 174.15 level or not. UNH, United Healthcare. Right away, I look at this. I see what appears to be some type of triple top. So we have the high here in April of last year. That was its all-time high. We came back to it again on the August peak. We failed again on the rally off of the October low, and we're selling off. Makes me think, just looking at this kind of loosely, that there's a decent chance here this is heading back down to the bottom of the range. So this is one I'd be less inclined to be a buyer of. You can see even here, look at kind of, you had some lows, 3 different weekly lows in a row, then another weekly low, and this week we're trading beneath it. So if on Friday we're beneath this kind of somewhat center line of price action, then good chance we're going back down towards 450. JP Morgan. Bank earnings coming out later this week. So the downtrend line has been broken. We can see that without me drawing it. This has been trending higher. So we rally, we pull back. It's moving higher again. Looks like it's heading towards 149 and change as a target. Support now is anywhere from 125 and change to about 121. So let's say $10 upside versus $13 to $18 downside risk. So I would tend to think this is going to move higher, but the risk reward isn't perfect by any means, because you're risky. If you bought it now, you're risking more than you would initially target. Can I make the case that this is going to go all the way back up to test, all-time highs? Right now, I can't. There's no reason to think that that's going to happen. So next, Walmart. Good bottom here. In fact, if one of the reasons we look at longer term charts, the bottom this in 2022 was also the bottom all the way back from 2020, at least on the June pullback. Certainly, anytime this seems to get up into this level, it has resistance, so it has passed through it minimally, right? One surging week through it to new all-time highs, and then the big fade from there. So it's still, again, even recently rejected that level. We did not get a proper breakdown of the bearish propulsion level, so that's actually still intact. And new highs would, or at least a test of the high would get us up to about 159.5, and then much higher highs over time. So would I be a buyer here? Again, I think my answer is going to be based upon, it depends upon how we close. If we close under, what is this level? 143.76 on Friday and trade lower next week, I would wait for it to come off again. Procter & Gamble sells off last year, perfect bottom in October on a weekly 13, turns around, comes up, stalling now since we've made this 9 count. You can see it is getting a lid on it. Let's call that 154.5 or so. If it breaks through, 157 and change is a target. That's a near-term target. Much bigger upside targets all the way at 193. On the downside, if this properly breaks 144, look for it to go to 133. I would think also, the cloud's not going to be that helpful in these things that are going sideways. Chevron has been stuck in a range for almost a year now. You can see that, it's edged slightly higher, but basically we're talking time. There we go. From there to about there has been the range. And it at least held, and it's still holding in here. So if this breaks out, we've got a whole bunch of targets between 191 and 198, then much, much higher, all the way at 263. Not much to do, honestly, not much to do right here in Chevron. If anything, you might give up something. If you're long, you might consider selling some upside calls against these strikes, because if it does fade, you at least will collect the premium on these. And if you sell anything between the 191 and 198, it's not a bad place to be a seller, I think, in general anyway. And the last name that we're going to use to finish off today's webinar is Home Depot. And so we look at the price action over the last couple of years. So this also bottomed in October on a weekly 13, came back to test the same high from the August high, made slightly higher, still got rejected by the bullish propulsion level at 334.5, but at least in the near term is staying above this 308.23 level. Like several other ones that have come down to hold against their bearish propulsion levels that we looked at in this webinar. You got to wait for Friday's close. If Friday's close is beneath this 308.23 level, I would probably think that we're going lower and that we're just back and forth in this range. If we can get a couple of Friday closes above 334.5, you open the door for a testing of those highs here from November, December of 2021. That is it for this week. I hope you enjoyed the show. I'm Rick Bensignor, and this has been In the Know Trader.